Joining us right now is the CEO and Chief Investment Officer of Mainstay Capital, David Kudla. David, good to see you, sir. Thanks so much for joining us.
Good morning.
So what do you think is going on? I mean, your reaction to what took place over the weekend in Saudi Arabia, where these 11 princes were jailed, and ministers as well, does that impact your thinking in terms of putting money to work in the stock market?
It doesn't really impact our thinking over the long-term or intermediate term. Obviously, we're always watching events in the Middle East. This is somewhat disturbing. We've seen the reaction in oil prices over the weekend. But from the standpoint of what we're doing domestically and globally in investments, an external event like this doesn't play that much into our thinking yet.
And the reason that I ask, Michael Block, is because obviously Kingdom Holdings, which was run by, well, the chairman was Prince Al-Walid. They have a CEO in place since 2016, but they own companies like 21st Century Fox, the parent company of Fox Business. They own Apple. They own Twitter. So it's a fair question to question those positions.
I'd say it is. I don't think there's any special sauce that Prince Al-Walid had. I don't think it's as if his successor is suddenly going to sell all those blue chips you mentioned and start trading penny stocks. So I don't think that's an issue there in terms of stability. There is a bigger question of stability. David, just thinking through what you're looking at now. I know home builders are a favorite cyclical play for you this year. What are your thoughts on the current tax bill where the mortgage deduction stays in place, but the cap has been lowered, which may hit the high end of housing? Is that something you're concerned about? Do you think that may end up in the final bill? What's your sort of evolving view on that, if you could?
Well, if we look at the iShares Home Builders ETF, ITB, we'll use that as a proxy, and that's actually the ETF that we hold in our portfolios. We saw on Thursday that ETF, when this news came out, the ETF sold off about 2.5%, but it's still up 40% year to date. Certainly, there will be those buyers that look at the cap on mortgage deduction or other factors in tax reform that could affect housing. But the secular forces, from a secular standpoint, cyclical standpoint, and more recently the event-driven standpoint of the hurricanes, we think the home builders are very strong. In fact, in October, we had a 10-year high in new home sales of 18.9%.
Very fair. It also looks like you're very bullish on large-cap tech and on Chinese internet plays, which, again, we've seen perform really very well. Is it fair to say that you're still looking at growth to outperform value? There's been massive outperformance. I'm actually still in the growth camp as well. Is that where you are?
Yeah, we're staying mostly in the growth camp. Now, certainly, home builders, you could argue, is certainly a cyclical play and maybe more value-oriented, more focused on economic forces that they need for a tailwind. But yeah, we're still with the secular growth stories. First and foremost is information technology. We're looking at 15% earnings growth for that sector this quarter and robust growth going forward. A saying we have, technology is eating the world, and the secular growth story for technology here and abroad is very strong.
David, it's Dagan McDowell. I've argued this for some time now, that one of the concerns that investors seem to be ignoring is what's going on at the Federal Reserve. With Jay Powell, he's going to be the new Fed chief, but we're finding out in the Wall Street Journal today that the New York Fed chief, Bill Dudley, is going to retire next year, 6 months earlier than scheduled. You already have Stanley Fischer, who stepped down just last month at the Fed, and it's still a question mark whether Yellen stays on the Board of Governors until 2024, which he's allowed to do. Again, this is a Fed that's tackling an unprecedented balance sheet and trying to unwind that. Why is the market ignoring it?
Yeah, when we look at a great question, Dagan. When we look at what's happening at the Fed now, there is quite a bit of turnover that we've seen over the past year and going to see over the next year with those departures, change in the chair of the Fed. We think that investors are largely or maybe aren't counting on the risk of higher rates coming. And we have not seen, even with forward rate hikes, we have not seen our rates in the U.S. go up that much on the intermediate and long end of the curve, the 10-year, 30-year, simply because rates around the world are still low. But that will be changing as well. We think we look at a 98.2% probability based on the Fed funds rate, that the Fed will raise rates in December. There are more rate hikes coming next year. Whether it was going to be a continuation of Janet Yellen or Powell, rates are going to go higher. And that impacts, more specifically, the concern is in bonds, interest rate sensitive bonds like treasuries, high-grade corporates. The U.S. stock market, as long as the economy is doing well, moderate rate increases are okay, and the economy is doing well. Back-to-back quarters of 3% or better GDP growth. So when we look at a growing economy, we can accept those rates when it comes for stocks. For bonds, investors need to be very careful about interest rate-sensitive bonds.
Yeah, David, real quick here, the tax plan, you think they get this done? And do you think that that is a further boost for the stock market?
If they get it done, it is certainly a further boost for the stock market. We've already seen some of it being priced in. If it doesn't get done, though, we don't think it derails this bull market. It's a short-term setback. But this bull market is based on strong earnings, the key fundamental underpinning for stocks, and this bull market is still intact.
David, it's good to have you on the program this morning. Thanks so much. We'll see you soon, sir. David Kudla joining us there.